Hello, my name is Demetris Theophanides and I'm the Director of XSpot Partners Ltd. Welcome to the market analysis for the first half of 2024. Global equity prices posted another 6 months of solid gains, building on an already excellent performance for 2023, with the S&P 500 gaining 14.5% and the Nasdaq gaining 18.1%. Most analysts and investment banks initially reported that 2024 will be a negative year for the markets, since interest rates remain at high level, but also because 2023 was an extremely positive year for the markets. Contrary to this, in our previous quarter analysis and in our weekly reports, we stated that there was a high probability for the S&P 500 to have another great year. So at least for the first half of the year, we seem to be completely justified. The closing of the first half of 2024 finds our model portfolios performing exceptionally well, with returns in line with the key benchmarks or slightly higher than the key benchmarks. Specifically, the Global Growth Plan closed with a return of 15.64% for the first 6 months of 2024, while the Growth ESG Plan recorded gains of 17.61%. The Balanced Plan, with an equal distribution between stocks and bonds, closed with a return of 8.71%. Our income distribution plans are moving positively, with the income plan moving 3.38% higher, while the high income plan has achieved a return of 18.11%. The conservative plan, with long positions in bond markets, achieved a return of 2.82% for the first 6 months of 2024, as expectations for rate cuts has shifted towards the end of the year and into 2025. In the first half of the year, interest rates remained high, since inflation rates remain above central bank targets. The US Central Bank did not cut rates for this year, even though the markets were initially expecting for rate cuts during 2024. The market's expectations for the rate cuts gradually dropped in line with the Fed's economic outlook for the year. Investors and analysts expect that the Fed's rate cut in the USA will occur in September. Taking into consideration the expected US elections in November, it is possible that we will not have an additional rate cut before the end of the year, as this can be considered as an election interference by an independent authority such as the Fed. It is worth mentioning that historically, stocks and bonds rallied during the period between the last rate hike and the Fed's rate cut. In any case, any interest rate cut will contribute to further economic growth as the cost of borrowing will drop, and this will of course support the stock and the bond markets. During 2024, we had 13 new all-time highs for the S&P 500, and this historically leads to a better second half for the markets, since the first half of the year is positive for the markets, then an equally second half follows with an above average returns. Currently, stocks continue to move higher as earnings per share also move higher. And as long as there is no indication of a recession in the USA and the global economy, then the markets are likely to reach new highs. In conclusion, we believe that the prediction we've made at the beginning of the year for yet another positive year for the markets is still valid. We will of course continue monitoring the global economic and geopolitical developments and market trends and adjust our strategies and recommendations accordingly. We advise our customers to stay invested for the long term in a well-diversified portfolio. Patients can outperform active investing over time, and a buy and hold strategy can help investors avoid missing out on the market's biggest days. Thank you for watching this video. Please stay tuned for more videos to follow.